All right, let me also welcome in the management of Laurus Labs this morning in conversation with them on a blowout quarter and superior performance coming in this time around. Satyanarayana Chava, founder and CEO, joining us. Sir, if you could first talk us through some of the major growth drivers for the quarter gone by, the kind of momentum you've seen this time around. Is it sustainable? What have been some of the factors at play?
Good morning. Our significant growth in Q1 and Q2 came from the investment what we made since 2016 onwards. If you look at our gross block profile, in FY16 it was 1,400 crores. By end of September, it was close to 3,000 crores gross block. And our R&D expenditure in 15 was about 55 crores. It went up to 165 crores last year. And we have increased our capacities on par with our gross block in APIs and also in the formulations. That led to our significant growth in Q1 and Q2. We have capacity, we had approvals, and there was a market for us to sell. And we expect the trend will continue. We are creating more capacities, and both in formulations, both in APIs. But very interesting to note, our custom synthesis business performed much better than our anticipation. Where you are aware, the margins are much higher than a generic business. That is helping us to lift the entire gross margins for the entire company.
Wonderful. What about on the capacity front then? Does that mean investing in more capacities across segments at this time to kind of capture the demand that you're seeing?
We have plans to invest both in APIs, formulations, as well as creating dedicated laboratories and dedicated capacities for synthesis. When it comes to APIs, we are adding close to 2 lakh liters, 20 lakh liters of reactor volume from now to the next 24 months. That is 50% of capacity what we have right now. And in the formulations, currently we have about 6 billion tablet capacity. That will go to 10 billion tablet capacities by end of next calendar year. That is almost 80% of increase than what we have right now. As of now, our custom synthesis business utilizes common infrastructure what we have. When we look at our prospects in custom synthesis business, we do feel they also need large capacity for their current projects and future commitments from the customers. So we are also investing into a new dedicated site for that division. So investments are going on into all three divisions, probably in the ratio of 40% into APIs, maybe 40% into formulations, and about 20% into custom synthesis business. We are also creating 2 new sites, one for formulations and one for custom synthesis, for which we are already in the process of acquiring land. And if you look at all these capital expenditure growth plans are majority funded by internal accruals. You can also see from our net debt in FY16, it is about 1,000 crores. By end of September 2020, our debt remains same. That means we are investing whatever cash generated in the business, either back into funding working capital or funding R&D or funding creating capacities.
Sure. Mr. Chava, also, since you did speak about formulation, I want to understand, what's really working in favor of you is better demand as well as new launches in the formulations segment, which is clearly driving growth for you. But is this really sustainable? Do you see it sustain, or for that matter, even better these numbers in the medium to long term?
We already mentioned in our investor call last week, we expect the Q3, Q4 will be better than the last quarter. We are saying because we have visibility in orders, we have visibility in capacity enhancement, and we have visibility in how the market is moving. And we don't have visibility, and if we don't need more capacity, why we will invest into significant capacity expansion? We're doing because we are very clear on our next growth levers, either it be APIs, or it be formulations, or it from custom synthesis. Interestingly, all divisions are performing very well. That is the reason we are having a spectacular growth in Q1, Q2, and we expect that will continue.
Good to hear that. Mr. Chava, in your management call, you also said that Laurus is in the process of building a product pipeline. Help us understand how exactly are you planning to move up the value chain?
When we said we are building the product pipeline, we are putting a lot of resources, both men, machines, and infrastructure, to meet and diversify our revenues from antiretrovirals. And when we looked at our current portfolio, both in APIs and formulations, 90% of our portfolio is non-antiretrovirals. That is a place where we expect sustainability will come, where we expect margins will be better than antiretrovirals. And also there is a growth. We expect a lot of growth. When we looked at our performance, what is also interesting, contract manufacturing of generic APIs for other generic customers is also a very growing business for us. We never anticipated we will become a contract manufacturer of APIs for other generic companies. That is almost 15-20% of our API business, and we expect that is growing. So a lot of resources are deployed to diversify our revenue base from ARV to non-ARV, and that is clearly visible. From 80-90% of revenues coming from antiretroviral APIs, today we are at less than 30% of revenue coming from ARV APIs, and we expect that number will come down in the future.
Okay. In terms of capital requirements as well, going forward, are you looking at internal accruals, any fundraising, anything on the agenda?
We may have to take some working capital loans to fund our huge growth. We may have to take some long-term loans to bridge our cash requirements to fund our capex. But we have very clear visibility. Majority of our cash requirements will be funded through internal accruals. Only part of it will be from loans.
Post-December, do you expect, once the US political landscape is settled, the impact of COVID will start reducing, do you expect that US FDA could go stringent again? Because our understanding is, because of the medical emergency, US FDA in a sense has been relaxed, and they in fact have given a lot of approvals which in normal course of time may have not happened.
Possible, but when we look at the regulatory track record of the company, in calendar year 2019, we have been through 16 regulatory audits and more than 60 customer audits. So our track record is absolutely clean. And in fact, for two of our facilities, we got to AAR in the last 2 months. So we have no pending inspections for any of our facilities. And it is good for the industry. So when regulators do their job better, it is good for the industry.
Okay. I'm going to ask you a very simple question, but a question which perhaps could have very deep-rooting impact. If COVID would have not happened, would Laurus have reported the kind of strength they've reported in the Q1 and Q2 numbers?
We could have reported better numbers. The reason I'm saying, our revenues are not dependent on any COVID-related opportunities. So it is negligible. And we have spent almost 30 30 crores so far to prepare for the COVID pandemic, either by increasing the shift timing or giving incentives for the people to come, our funding to the local governments, and taking care of our colleagues. So we have spent close to 30 crores in the H1 towards COVID-related expenses. So if there was no COVID, it is very surprising to say, if there was no COVID, we could have done better than what we have demonstrated. So in future, whether COVID or no COVID, I don't expect our growth will have any impact.
Closing comments. How much of your current portfolio you would say is a pricing proof portfolio? Because in API, there is a cycle which happens. API prices, they tend to behave like commodity prices. How much of your portfolio you would say is insulated from the commodity cycle?
Majority of API revenue is shock proof for external threats because of a leadership position. If we are not a leader in a particular API and we have to follow somebody for pricing, somebody for capacity, then we will have a challenge. Whereas majority of our key products and many of our oncology products are shock proof because we are the leader. So that threat is minimal. In fact, the margin gain what we have witnessed in H1 is not because of price increase, is because of our improving efficiencies. So we don't see that threat in the short to medium term.